Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome to the KE Report Weekend Show. Corey and Chad here, your hosts for this weekend edition. Also your hosts on our website, podcast, and YouTube channel, highlighting day-to-day market moves and company updates. Please be sure to go back and check out all our daily editorials and company updates. This weekend show, we're going to take a step back from some of the day-to-day moves in the markets and also the day-to-day economic data that we get. Take more of a big picture look at the economy and at markets, especially in the US, but I'm sure we'll be talking global markets as well. We're kicking off this show with Peter Boockvar, Chief Investment Officer at Bleakley Financial Group, also editor of the Boock Report on Substack. Now, Peter, through your Substack, you send out multiple notes every day highlighting earnings calls, market moves, economic data, and really anything else that is relevant to markets and also the economy. Look, there's no denying that the economy right now is really in turmoil. No one really knows what's coming in terms of tariffs, in terms of government policy, and that's handcuffing a lot of companies and I think a lot of traders, just judging by the day-to-day volatility that we're seeing without real direction, it seems like, in markets. Arguably downward bias, but Peter, your general take, if you could summarize everything that you've been sharing with your Substack subscribers, what would that takeaway be for the economy and the markets?
Certainly a high level of confusion and disarray if you're a manufacturer or a retailer or somebody who's procuring product in China and other countries. But I think it's important to look at this big picture because before even the tariffs came about, there were sort of shifts in the ground underneath us. You know, we came into the year with tech stocks driving the bus still, the AI tech trade running on all cylinders. Actually, I shouldn't say on all, on most. And the reason why I say that is because it seems like the back half of last year, investors started to sort of differentiate the AI tech trade and questioning some of the huge amounts of spend taking place. You know, use Microsoft, for example. Coming into the year, Microsoft stock actually peaked in June of last year. And people started to view Microsoft as more of a capital intensive business instead of a free cash flowing, a robust business. And then you, of course, had the DeepSeek news late January that completely disrupted and sort of broke up, I believe, that the dominance of the Mag 7 trade. Tesla obviously had its own issues with the, focus of Elon Musk on other things and questions about the state of their auto business. And then, you know, the lack of an AI Apple Intelligence upgrade cycle for Apple, and now questions about Google's reliance on search that is being disrupted, and so on and so on. The point there is that if you lose 35% of the S&P in terms of leadership, it's important to quickly find other things, because if the stock market begins to show shaky legs, you know, that can flow into the economy, because the economy has benefited from that AI tech spend, has benefited from upper income spending, where these upper income households have benefited from high values of their stock portfolio and home prices. And then, of course, anything benefiting from government spending. And then getting back to Musk, we know that anything related to government spending has also been a huge boost to economic activity. So then you throw in, of course, the tariffs and all the uncertainty that creates in terms of one's visibility with their business, particularly if they are part of the global supply chain, whether they're buyers of it or suppliers into it. And that has caused, obviously, a lot of angst. You know, there's one thing to say, okay, we're going to raise tariffs on this and that over a 12-month time period where businesses would be able to sort of plan around that, instead of, okay, we're going to raise your tax to 145% next week, go deal with it. You know, those are two completely different things. And granted, we've taken off for 90 days the reciprocal tariffs that mature on July 9th, and versus the uncertainty now with how the Chinese negotiations are going to go. But that's no way to run an economy. That's no way to disrupt small businesses in particular who just don't have the ability to quickly maneuver and adjust under that circumstance. So the odds certainly are growing for an economic downturn. I think a big part of that sort of question will be how the stock market deals with this from here on out in the sense of influencing upper income spending. My point there is that if the stock market breaks down again and we retest that 5,000, 4,800 level and break below and don't have a quick snapback, then that would dramatically raise the odds of an economic downturn. So a lot of balls in the air here. Unfortunately, a lot self-inflicted, but the days of the US market commanding 22 times multiples on a forward basis, the days of seven stocks leading the way without any help from other parts of the market, I think are over. Investors are luckily, though, finding other things to buy, whether it's domestically or internationally. I just think that there's a transition phase that we're in the midst of here with obviously major economic disruption risks like I just laid out.
Yeah, Peter, I think that's a great summary. And you were early on the case, even last year, talking about the huge spend into AI and tech companies, but maybe not the profitability on the other side of that, and how at one point valuations will matter. And it seems like as we rolled into 2025, they started to matter more. And then as things escalated, yeah, we've seen a rotation out of the tech leadership, the Mag 7, and into a wider breadth of companies. But there is so much uncertainty with the tariffs. You're on a lot of different conference calls and quarterly earnings reports with companies. And it's interesting what we're seeing as far as guidance, or sometimes no guidance at all with relation to the tariffs, and in particular, how it's impacted not just the mega corporations, but also the small to mid-sized companies. So maybe dig in on that front and what you're seeing when you sit in on a lot of these calls or when you read the transcripts. What is the trend as far as guidance for the rest of this year from the middle America and the mid and small cap companies?
Well, those companies that are giving guidance, they're widening the ranges of their guidance. They're almost doing sort of scenario planning. I think maybe it was United Airlines early on in the earnings season saying that, under current economic circumstances, we can make between A and B, but if the economic downturn is more pronounced, we'll make between C and D. You've had other companies that have just not even bothered to give any guidance because why lay themselves out there not knowing how this plays out? And then, there's some companies that are maybe less exposed, but still acknowledging the risks out there. And I've heard plenty of companies that say, our guidance, we're giving guidance, but the guidance does not assume further economic weakening from here. So there are a lot of caveats out there, and companies are trying to figure it all out and doing their best to manage it. But obviously, small companies just don't have that same flexibility. And when we say small, well, small can be defined in many ways. Real small, legitimately small, maybe those companies with less than 50 employees, and that's how sort of ADP when they report their monthly jobs data and they define small businesses as that under 50 and very small under 25. If you're in that sort of range of business and you've sourced in China and continue to, well, who knows if you'll even make it through this? Because while U.S. leadership, Bessent and Jameson Greer are meeting with one of the top Chinese trade officials this weekend, who knows where this will lead? And even if tariffs get cut to call it 50% from 145%, I don't think many businesses can even survive a 50% tariff. So there's a lot of sort of things to power through here in terms of gaining clarity. And I feel for these small businesses that are subject to this. I've been trying to point out to people that I understand and I share the sympathy of the concerns of how trade has gone with China in terms of U.S. manufacturing losing jobs to China. But, a lot of that has to do with just lower valued stuff that was going to naturally transition out of the U.S. anyway. as just lower cost ways of doing business in outside of the US were taking place, like in apparel and toys, for example. But China took our market share because, yes, they had lower costs, but because they were also very good at what they did. But I also share the sympathy of, well, they've stolen technology from us and IP and so on. I get that, and it's terrible. But the history of business, unfortunately, is fraught with stolen IP. The U.S. was stealing IP from the Brits in the 1700s. Steve Jobs went into Xerox PARC and stole the idea for the mouse. So it happens, and I get it. But to throw U.S. supply chains in disarray over that, I think there were other better ways of managing that. But, the stories I hear on a daily basis of, I don't know if I'm going to make it through this because of my reliance on certain things from China, really concerns me. And not only for those businesses, but, the broader ramifications because we rely so heavily on small business.
Yeah, that's such a good point, Peter. And that's what we keep on hearing, right? Is that some of these large companies like Apple, they can go to the president and we see the sort of concessions that they get. Even the car manufacturers, these larger companies, they have access. The smaller companies do not, and that makes it very difficult for them. But also your point on why China became such a major producer of a lot of the goods, or at least some of the goods that the US buys. That's just the way the world has gone. And I feel like the US citizens have benefited from this agreement as well. They had cheaper goods. Quite frankly, Americans are very much consumer focused, and China filled that void. But Peter, do you understand what the end game is here? How the world could, I guess, get remade after Trump is done with these tariffs, whenever that might be? Because we hear it's about onshoring manufacturing, but all we heard from Apple was that they're moving manufacturing to India from China. So we're not necessarily seeing all these warehouses and manufacturing hubs being built in the US. What is the end game here in your eyes?
Well, apparently there's not any one end game. I mean, just look at the UK deal, which is more right now a letter of intent, as the actual deal is not done yet. The US has a trade surplus in goods with the UK. So I'm not sure why we still are leaving a 10% tariff on them. So it's not about reshoring with the UK. It's really more about knocking down some trade barriers, which I applaud. But with the 10% tariff still staying in place, it's more of a money grab instead, or I should say, in addition to. So there are a few different things there. If you talk to Peter Navarro, he wants to vertically integrate all of US manufacturing. He said on CNBC a couple weeks ago, I don't want to just assemble cars here. I want to make the transmission. I want to make the engines. I want to make the tires. Well, okay, on paper it sounds great. We're going to make everything about a car in the US. Problem is that the cost of that product is going to be so high that there aren't going to be many Americans that are going to be able to afford it. And you can forget being able to export that auto in a cost competitive way. So what will happen is a US car manufacturer, instead of making cars here for, yes, the domestic market, but then selling them overseas, well, you're not going to be able to compete. So what you'll do is you want to sell cars in Europe, you'll just build a plant in Europe and source your products around the world, ex-US, and sell those cars there. So not one US manufacturing job will be created for the export market. And in fact, you'll see a collapse in exports because we won't be able to compete with other parts of the world. So I don't understand his thought process. He's thinking very, very linearly and not understanding that we live in a non-linear world and not really fully connecting all the dots. With China, I understand the desire to protect US IP and maybe open up more of their markets for our products. I get that. But I don't get, like I said, tariffing, the model train set business in the US in order to achieve that, or tariffing the imports of socks. I don't know how you get to an IP agreement from that. So I don't think it's clear what the end game is. I think One of the problems is the administration and Trump are working off a false premise that a country you have a trade deficit with is ripping you off and basically stealing money from you. It's nonsensical. So for all these reasons, I understand some of the purpose. We lost U.S. manufacturing jobs over the years, but as a percentage of U.S. private sector payroll employment, we've been losing them for 75 years since World War II, and that's because of production efficiency and automation and so on, and just the U.S. just had a higher cost structure than other countries. But when you have a few $1,000s per capita income, you're going to have lower wages. You're going to be able to compete in different ways, but that's what the world is all about. Not everybody runs their country in the same way. Countries like to protect certain industries, whether we like it or not. I mean, look, the U.S. government essentially finances most of the U.S. residential housing market. We subsidize it. This is just, and it just happens. We can try to level the playing field and lower trade barriers. No doubt we can compete as well as we can in certain things, and other things we're not going to be able to. But just the approach and the view on trade that somehow it's a zero-sum game, and also leaving out the huge trade surplus the U.S. has in services with the rest of the world, like somehow that's forgiven. And are we ripping off other countries because we have a trade surplus in services with them? So it's all very unstable, chaotic, and I don't fully get. So I'm not sure what the end game is. I don't know where tariffs come out in terms of rates, but I do know that the tariff rate at the end of the day, if the 10% baseline stays on line, that we're going to have the highest tariff rates in many decades. To what benefit, I'm not sure.
Yeah, Peter, it's such a complicated mix of factors right now. And if we were talking to you just even a couple of weeks ago, all we heard in the media was cries of, "Hey, it's really the end of the world," in financial terms. And we were hearing that not just was there uncertainty, but that we're going into recession, maybe another Great Depression. And then the stocks had really tanked. The only thing that was really holding up was gold as a safe haven. Even bonds and the US dollar hadn't held up that well. But then over the last couple of weeks, we've seen a reversal of fortune where the dollar's picked up a little bit, bonds have got a little bit, but amazingly, the stock market has shrugged off all of this news that they were worried about a couple of weeks ago and blasted up to higher levels. How are you balancing out the volatility in the markets with the expectations of a financial contraction?
I think the markets rallied back. I think on the hopes and the beliefs that, well, it really started with April 9th when the reciprocal tariffs ex-China were delayed for 90 days. That's what sort of got this going. And then the belief that, we would have these big, beautiful deals and everything would be fine. But I think that the UK deal showed us that even if you have a trade surplus with us, even if you're one of our closest long-term allies, we're still going to slap a 10% tariff on you. Now, the market obviously doesn't care about that today, the day we're taping this, but I think it will at the end of the day, and that we're not going back to where we were before April 2nd. And yeah, we've had the extra steel and aluminum and auto tariffs, which I don't think are going to do anything any good. So I just think that there's just a level of optimism that things are going to be just fine. But, in a way, the S&P at about 5,700, we were 5,671 on the April 2nd close, minutes before that Rose Garden reciprocal tariff announcement. So to me, around these levels, we're still down obviously from the highs, but yeah, I think it's hopes that everything's going to end up being just fine. And I wish we were. I think that a lot has changed and a lot of big picture things have changed, and foreign flows into U.S. assets, that trajectory has changed, and there's less money, not only less money coming into the U.S., there's more money coming out. And like I said, the Mag 7 trade is done. So I think a lot of big picture things have changed. The government spending is not going to be the same level of GDP boost as it was. We saw that in Q1. So big picture things are changing here. So I'm circumspect of rallies. Where it plays out, excuse me, potentially on the downside, I don't know. But I think that helps to explain this sort of, wide volatility that we're seeing, and with now on the upside to that.
That also ties into this narrative that we are hearing a lot of is this sell the US, money exiting the US, whether it's going into international markets in terms of European markets have been outperforming US markets, or even going into precious metals as a safe haven. Gold, especially, we're seeing the dollar broadly lower. We're seeing bonds. Those aren't the same safe haven bid that we have seen in the past. And again, markets, yes, they're volatile, they're off their highs, but doesn't seem like there's that international flows in terms of money. So, Peter, is this part of that whole narrative that could be longer lasting, or again, is this just temporary?
No, I think it's potentially longer lasting because I think, and I'm going to sort of again try to tie things together here. The Mag 7 trade has been a global trade. Wasn't just a benefit to institutional and domestic and retail investors. It was a global trade. It was a global reserve asset for many international investors, both private sector international investors and public sector. Public sector where the central banks like Swiss National Bank and the Norwegian Central Bank had big positions in US stocks. And I am very curious to see the updated 13 DNF filings, last updated December 31st and newly updated soon as of March 31st to see, and that's before April 2nd, of course, of these fund flows and to what extent foreigners have been trimming back. And I have to believe in April, they probably, early April at least, they trim back some more. So I do think that if they're going to trim back the Mag 7 trade, well, the US markets in terms of big, liquid, dominant names are just less attractive. There are other things to buy in the US, but I think it opens up a whole world of other investing opportunities and not just US tech stocks.
Well, Peter, to that point, a lot of people were claiming a year or two ago that U.S. tech stocks were safe havens. Obviously, we've seen in 2025 that's clearly not the case, but the concept of safe havens has come back into the mainstream ideologue again. And the question I have for you is bonds didn't really react like a safe haven this year, neither did the U.S. dollar. Gold held up well. Bitcoin's kind of all over the place. If we do see a downturn in the stock market rally and some of the air comes back out of this recent enthusiasm and we do see a market contraction, where is the safety play? Where do you go for a safe haven?
Well, gold certainly has proven to be one of those, but the thing with gold is that is it a are people buying it for a safe haven or they're buying it because they legitimately want gold a bigger percentage of their reserve asset holdings because they just want to own less dollars. Now, they can say that as for safety reasons or just they are reassessing their view of holding, X amount of dollars in their portfolio. When it comes to safety in terms of not losing money in nominal terms, nothing beats that T-bill. But yes, you can bucket gold into that safe haven trade, but I never want to say, okay, the world's chaotic by gold. Gold has its own unique characteristics and why people want to buy it. And it's really becoming this global reserve asset that people feel like they need to get their hands on.
What has been your take on the money flows into gold balanced by central bank buying, also inflows into the ETFs, Western investment? It seems like kind of all around the world, people are investing in gold, especially through the ETFs.
Well, what was most interesting, of course, as we all know, was the response post the Russia's invasion of Ukraine and the freezing of half of Russia's central bank reserves and how quickly foreign central banks responded to that by ferociously buying gold over the last 3 years. Only recently, we're now beginning to see increases in gold ETFs as maybe Western investors are realizing the importance of owning gold. So there's certainly been a rethink. But when you think about this gold bull market, it's been going on for 25 years now, obviously interrupted by an almost 50% correction in the mid 2010s that bottomed in 2015. But when you look at certainly gold relative to the S&P, it's outperformed it. This sort of last leg up in gold is for the reasons, stated since 2022. But, there's been plenty of reasons to own gold, whether it was the central bank experiment with zero rates and negative rates and QE and so on. us gold bulls have been given plenty of reasons to own it. And I don't see that changing anytime soon. It will change at some point. There will be a time when at least a portion of your portfolio in the metals will be due for a sell-off or a correction, or that doesn't bounce back, and maybe an end to this bull market. I don't think we're there yet, but we will at some point. And hopefully we're smart enough to take those chips off the table, putting aside, the gold that some of us want to hold forever.
Well, Peter, gold's a unique asset in that it's considered a commodity, but it's really considered a currency of last resort. It's considered a monetary asset, and it's held by central banks. But when you look at the rest of the commodity sector, it's very much dependent on supply and demand. So when you look at what's happened in oil, still, as we record this, just barely down below 60, bouncing back a little bit, but it's tanked over the last month or two. When you look at what's happened in base metals, not a lot of traction there. Even some of the soft commodities and food commodities are not really rallying. And that also depends on China, the mouth of the world, to also keep importing a lot of these commodities. With so many trade tensions with China and calls for an economic contraction, how are you looking at the commodity sector broadly?
All right, so sort of breaking that down, yeah, you take ag, for example, corn and soybean prices are still pretty depressed. Interestingly enough, the fertilizer stocks have sort of gotten some life. We've been bullish along those names. Uranium on a spot basis has pulled back, but term premiums are still pretty good. The industrial metals, obviously, there's this push and pull between worries about the demand side with economic activity, but on the other hand, the global need and desire and sort of emergency for some to get their hands on these crucial materials if we're moving into this very sort of unbalanced multipolar world where you have copper prices that even with these economic concerns is still hanging in there. Natural gas prices have traded pretty well, but oil prices have not. I think crude oil at WTI at $60 is dirt cheap. I think what was interesting was the Diamondback Energy earnings call a couple of days ago, where the CEO basically said you're going to see a decline now in U.S. shale production, and not just because oil prices are low, but also the geology challenges, which is pretty interesting. And that's where you have low prices curing low prices, where U.S. production cuts would offset the increase that OPEC has announced. I think on the silver side, corollary to gold, that it's trading pretty well. And, we still have a bull market left to the upside in silver at some point. Platinum is one of the names, one of the commodities that we've bought most recently in late last year that I still think is half its value of about 14 years ago. And that hybrid vehicles are winning the sort of VHS Betamax war against full-on EVs, and catalytic converters are still going to be needed, and the demand for platinum will still be needed. But I think overall, as an asset class, I think it's going to come into more favor as, getting back to my theme of the Mag 7 trade being lost, that investors are going to search out other values. And I think in the commodity space, particularly, throwing gold miners there, and I know we all know that well, that value opportunities around the world are going to become more in fashion, and commodities sort of fit that bill.
All right, Peter. Thank you again for this really wide-ranging discussion on where the economy and where the markets lie. It's so important right now, but also impossible to know how this is all going to play out. But when you're an active investor, it is important to be positioned, especially when we could be seeing some major changes in leadership and in money flows, changes that really could upset what has been the standard for decades now. Again, we don't know how this is going to play out, but boy, a lot is happening this year, and it's hard to keep a handle on exactly what's happening to it all. But again, that's why I like reading over your Boock Report on Substack that you send out multiple times a day, covering different data points and market moves. So, Peter, great having you on the show. Again, Peter Boockvar, Chief Investment Officer at Bleakley Financial Group. Peter, we're going to chat again probably in a month or two time. And everyone stick around. We're going to be right back again, continuing this focus broadly on what's going on in the economy and in the market.
Thank you, guys. Appreciate having me on.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. I hope everybody enjoyed those first two segments with Peter Boockvar. Always find Peter's analysis on the economy and the markets very interesting, especially the big picture takeaway, which I think is so important right now as we just keep on seeing these wild day-to-day, week-to-week swings, but still a lot of, I think, negativity around the markets and the economy. We're going to continue this more macroeconomic and market landscape commentary now with Marc Chandler. Marc is the managing partner at Bannockburn Global Forex, also editor of the Mark to Market website. And Marc, you're another guy that I go to actually on a weekly basis usually to get your take on what we're seeing in the economic data and also specific market moves, especially the large currency markets. The big shift from this Trump presidency is this, I think, shift away from the supply chains that have been built up in the U.S. or by U.S. companies really benefiting from cheap labor in China and also other countries. That seems to be coming to an end. Again, it's maybe a little too early to say that, but boy, oh boy, we're getting a lot of pushback on where the U.S. has been getting their goods. So, Marc, how do you see this all playing out where these supply chains, they have been developed by a lot of U.S. companies over the past decades. Americans have benefited from these cheap goods coming in. What are the big changes you're seeing right now?
Yeah, I mean, I think this is the kind of time I think that we really need like a historical perspective. I think there's two ways traditionally that companies can service foreign demand. And that's important because just like credit cards allow us to live outside beyond our means in many ways, global trade and exports or foreign demand allows us to live greater than our own aggregate demand. And so this has become, of course, that's like what international relations and international competition is about. And so the traditional approach has been exporting. But after World War II, the strong dollar and protectionism, especially in Europe, encouraged U.S. companies to evolve their strategies. And the strategy was, instead of exporting to service growing European demand, it was going to be built locally, sell locally. And this is really what globalization under this sort of the Pax Americana means. Foreign direct investment, it's building plant and production outside your country. And that requires then, necessitates like a division of labor, supply chains, and then how those different nodes on the supply chain relate with each other, and that involves transfer pricing, internal pricing within a company, which allows or facilitates different tax strategies, but also protects your company from volatility in exchange rates. Because what happens is, instead of, for example, you're looking for an acquisition in a U.S. company looking for an acquisition in Germany. One way, which many of the banks would probably recommend, is you just go out and buy those euros. But if instead of buying the euros, you borrow them from a local bank, you in effect then have a euro liability and the euro asset you're buying, and you're neutral with currency movements. And so this strategy, this direct investment strategy, was how the U.S., I think, dominated to such a point that when records were first being kept in the early 1960s, already then, the sales by majority-owned U.S. affiliates, branches of U.S. companies abroad, were selling many times more than U.S. exports. But Europe and Japan, throughout the 60s and 70s, still had an export-led model. And that came to a head in the U.S. and Japan in the 80s and early 90s. And the combination of protectionism and the sharp appreciation of the yen driven by the Plaza Agreement forced Japanese companies to adopt that same direct investment strategy. Build cars in the U.S., don't export them as much. And now I think that what President Trump is doing is saying that that strategy is no good. That strategy carves up the American middle class. We want to bring back production onshore. And to me, a couple problems is one, is we might be able to bring back production onshore, but it's not going to have a lot of jobs associated with it. Remember, only about 4% of Americans work in what's considered manufacturing. And out of that, only about half of that is really engaged in the production of goods. Because remember, if you're working at a say an auto parts company and you're a secretary or an accountant, you're working in a manufacturing company and your job is often considered manufacturing. So I think that robotics, automation, AI is all going to make these modern factories, if we bring back production to the US, they'll make them so they not really have a lot of employment associated with them. And also, I think that this idea of a direct investment strategy is really evolutionary. It's evolutionary in the sense that companies have to adapt to a changing international environment. And what's characterized the international environment, of course, is many small countries with their own trade rules, with their own rules about domestic content protectionism, and you have also wild, sometimes dramatic currency fluctuations. It's really cool to say, that currencies are free floating, or the market should determine them. But ultimately, what that means is that they're volatile. That's how companies and countries experience it. And so, a direct investment strategy allows this almost, I'd say, it's a evolutionary strategy that allows coping with a world in which you have a lot of different countries, high mobility of capital, and volatile exchange rates.
Marc, is it even plausible for the US to bring back a significant amount of manufacturing, even if it is automated and AI generated, so there aren't tons of jobs? Do you still see a shift coming even from the bigger companies, simply because look at what Apple's doing? Instead of bringing back iPhone manufacturing to the US, they're just shifting it from China over to India.
Yeah, I suppose it's going to take some time to really sort this out. It probably going to be company specific and industry specific. So some sectors might come home more. Some places that are more targeted, like semiconductor chips. Pharma looks like it's going to be targeted. And so we might see some industries do come back onshore. And again, it's whether it's going to be job efficient, how much money is going to be spent, how many jobs will really be created.
And that is just what time will tell, right? We don't know how that's all going to play out. But in terms of what that means for currencies, that whole direct investment strategy, where does the US dollar fall in all this? Because it has been under pressure, but it's still right around that 100 level on the dollar index, which is still historically in the, let's say, higher range of trading. So what does that mean for the dollar in the big picture?
Yeah, I think that the dollar really tracks more Federal Reserve policy, interest rate policy, than it does these big macro, big picture things. I think that for investors, knowing sort of where we are in the big picture is helpful in terms of the broad picture and how the different variables can interact. But I'm still in the dollar bearish camp, but I did think that we have a bigger correction than we've had. To me, when I look at the dollar index, I see it peaking about a week before the inauguration. And that peak was really like a 3 or 4 month dollar rally that we had as the market was pricing in the Trump victory. And that was despite the Federal Reserve cutting interest rates. But the dollar index has been falling. It fell basically from the middle of January till like late April or so. But since then, I have been thinking that with the momentum indicators stretched, with a lot of the news priced in, and maybe the news is actually the real sector data coming out a little bit better. Not so much with that GDP number, which we know is distorted, but the jobs data seemed better than many people expected. But rather than really correct much higher, it seems to me that the dollar is broadly sideways. I had looked for that dollar index to go to 102, maybe 102.5, something like in that kind of area. And I thought that was conservative just based on retracements from the last leg down we had that began in late March. However, it's another week in which we saw, like the previous week, we get a good move on Thursday, looks like a breakout and then no follow through ahead of the weekend. So I'm not ready to write it off that we're done with the dollar's upside. But I think what the general takeaway, I think, is that the market is demanding, because of the uncertainty, market's demanding a higher interest rate premium to stay long the dollar. And so I think that's partly what's happening, is that even though the U.S. rates have risen, not sufficiently to really compensate for the risk. And I think that is why we've seen a broad decoupling, say, of the dollar from the 10-year yield, or from the 2-year yield against Germany, 10-year yield against Japan. So I'm concerned that in the big picture, we're still headed down for the dollar. And it's really right now whether we get a consolidation phase or whether it turns to an outright correction. So far, the dollar index has stayed below even minimum retracement levels.
Yeah, 102 or 103 level, I see that as being so critical on the chart because it was really a top for the dollar ever since, let's say, 2002, the whole way up to about 2022. So 20 years where 101 or 102, 103 was the peak that we saw. And now it's been trying to hold above, but again, it's been stuck below right now. Marc, so much of this policy seems like it's focused on China. Again, the big macro aspect here is trying to eliminate what China could do in terms of, I guess, taking more market share in the global world. However, it seems like a lot of these policies have just further pushed China to develop other trade agreements and also in the tech sector, develop their own tech sector in terms of chips, in terms of AI. Do you see this as, in a way, pushing China to make new deals to build up their own industry, which could come back to hurt the U.S.?
Yeah, I mean, I think it's a tricky situation. And here's why. I think that if you follow my story about this foreign direct investment, here we are where China, it's not really exporting more than other countries. It's not as dependent, say, on exports as countries like Germany or Canada, for as far as big countries go. China exports less than 20% of its GDP. But because the China is so big, the scale is so it's daunting. And so I think that if we try to choke China off, and that is by denying it both strategies, by denying it exports, and that's through higher tariffs. And part of what we saw with the April trade data is that even though Chinese exports to the U.S. fell sharply over a fifth, that Chinese exports to the rest of the world increased sufficiently to offset it in full. So at one point is that China export prowess continues. It's not exporting a large part of GDP, but it has found different sources of demand as it diversifies away from the U.S. But what concerns me is that the way we gave Japanese automakers the way out was building locally, selling locally. But because many people in the U.S. especially think of China as the enemy, they don't want to open up the U.S. to Chinese production. So instead of importing these goods from China, let them build it on a shore, like we're having Taiwan do with the semiconductor chips. But because of this ideological divide, many people are reluctant to do so. And the danger is that in these trade talks that the U.S. has with various countries, it also builds up a bloc who's also against foreign direct investment by Chinese companies. And it's a bit like after World War I, Keynes writes an essay basically that talks about he says the economic consequences of peace, and he warns against the bleeding of Germany, not because he liked Germany, but because he knew that if these onerous demands were placed on Germany, it would not result in the kind of behavior that we hope for. And I think the same thing is true with China. If we block them from exporting and we block them from direct investment strategies, it's not going to lead to regime change in China. It's going to lead to more nationalism and more efforts to carve out their own sphere of influence. And so that's what concerns me, is that we're backing into a lesson that I think we should have learned before. We've got to make room for China at the table, or there's going to be greater disruption. And it's not, I'm not saying this, like I say, it's sort of like Keynes's attitude towards Germany. It's not like he liked Germany, but he realized that realpolitik has certain dictates to it. So bottom line here is I am concerned that the confrontation with the U.S. and China, that the trade talks that are scheduled for May 10th are not going to really go anywhere, that this is still going to lead to, even if in the best case, the tariffs are cut in half. I think that 60, 70% tariffs would still be prohibitive and tantamount to an embargo between the two largest economies.
Seems like we've been seeing this for years now, though, with some of the embargoes that we've had on some Chinese goods, also the limiting of chips that the U.S. was allowing NVIDIA to send over them. It's made China develop their own chips and develop their own technology. And recently, we also had that Harvard professor that just went over to teach in China. So it almost seems like this shift, including the BRIC nation, some of these trade agreements that China's been coming up with, seems like this has been a long time coming, but it's almost speeding up right now. Are you seeing that as well?
Yeah, I think that maybe there has been a tipping point. Maybe the tipping point is that, say, up until now or up until the election, last year's election, that China was pushing the edge of the envelope in many ways. And I think that since Trump's election, we've seen not encroachment, but abdication, where the U.S. is leaving holes like it did when Trump pulled out of the Trans-Pacific Partnership trade agreement in East Asia. The U.S. has pulled out of the World Health Organization, the Paris Accord. I saw a story that said that the U.S. Is trying to get all companies, even foreign companies that do business with the federal government, to drop the DEI efforts. And so to me, this is not a case of isolationism that some people claim, but it's really a case of unilateralism. And so I think that in the big picture, that's what concerns me, is that I think it's been fairly straightforward that China could replace the demand caused by the U.S. embargo. And it can replace the demand like we saw with the April trade numbers in other countries, or it could have more serious efforts to boost domestic demand at home. I think it's going to be harder for the U.S. to replace the supply from China, even though it might take a while to see it, because businesses have built up inventories, critical earths, electronics, you name it. And so it might take a while, but I think that a bunch of things are sort of coming to fruition in next month, June or July. The cargo shipments that are now like leaving the West Coast ports empty, how that's going to filter through in the next 15 to 25 days to the Midwest and then the East Coast. I think about student loans having to be serviced again. I'm thinking about the drying up of foreign European and Canadian tourism to the U.S., besides boycotting U.S. brands. I think how long will the U.S. businesses' inventories last, assuming they began building them up in March with the first, like February, with the first signs of tariffs. So 3 or 4 months, that should bring us probably to the summer as well. And that summer, of course, July, is when the reciprocal tariffs come back to the fore that haven't been negotiated away.
Yeah, what a big question mark. Hey, is when are these inventories going to dry up? And also outside of China, I live in Canada, and all I am hearing, all I am reading, and even the businesses that I know up here, everyone is looking for different trade partners. They say that they would love to do business in the U.S. because it is just easier for them, us being simply above. Drive across the border, get your products down into the U.S., but it's been challenging for them. So everybody, it seems like, at least in Canada, and also seems like around the world, are looking for other trade partners. What have you been hearing from any of your clients that are international, that do have the ability, a bit more than just those U.S. clients, to look outside of trading with the U.S. and building up other trade agreements?
Yeah, no, our clients are mostly domestically based. But I think you're right. I think this is what we see in Canada. You know, for many years, people talked about Canada needs to diversify their exports away from the U.S. The U.S., I think, took, say, 80 to 90% of them. And so this is finally going to get Canada to do what it sort of should have done a while back. And I think we're going to see that in other countries as well, that the U.S., what I say is the U.S. abdication, by U.S. taking a step or two back, I think other countries will move forward trying to tighten up their other, like protect their flanks. I think that's what we'll see China do with the East Asian countries. I think we'll see even better trade relations with them and Japan. I think that Europe is going to, I mean, what we're seeing, I think, in Europe is really greater economic integration, as well as Europe having a different attitude towards China than the U.S. And especially with some of those countries, I know that they've fallen out of favor a little bit lately, like Hungary and Slovakia, but they're allowing Chinese direct investment into the EU, even if it's not Germany and France quite yet. But I think that other countries will allow it to happen. And again, so the U.S. really becomes more isolated economically. And I think it'll end up to be, I think, a better thing for global security, having sort of diversifying away from the U.S. and the U.S. consumer. And partly what this means then is if the U.S. is going to be importing less from the world, that means it won't need such large capital flows either. And so that's probably what we're going to see, right? I mean, I imagine this is what people are talking about, that the foreign capital leaving the U.S., U.S. capital leaving the U.S., so it hasn't been so apparent lately. I think that we had it scare last month. But I'm just pointing out this balance then between the trade account, or the current account, broadly understood, and capital flows. Smaller deficit, if that's the net consequence of the tariffs and lack of containers coming to the U.S., smaller trade deficit, it means that the U.S. will need less capital coming in.
What does this all mean for markets then? Because that almost ties into that big picture theme that we've been talking about, is capital leaving the US in terms of financial markets, the dollar, bonds, even the markets. However, the markets have come back. You look at the S&P and it's less than 10% away from its all-time highs. It's taken back all of those losses that happened post-Liberation Day. What do you think this all means for capital flows into, or quite frankly, out of the U.S. and overall health of the U.S. markets that have been globally dominant?
Yeah, I think that partly, if I'm right about what's happening, the big picture, I mean, the U.S. brand has become spoiled, or soiled, I should say. And I think that means that U.S. companies, this intangible value of a U.S. brand or U.S. company with better returns on investment, superior performances, I think that gets more called into question. I think that I'm nervous about the S&P 500. You know, we talked before, actually in early April, about what kind of bottom we should be looking at. I am surprised how fast it's gotten back up here, but my best guess is we're not really going to get in the S&P 500. We're trading almost 5,700 before the weekend, and I think that not much above 5,800 before we have to turn back down. I am concerned about the broader direction of the economy as well. So cyclical factors, as well as the structural about the U.S. brand. When it comes to the dollar, I think that there could be a little bit more upside for the dollar. Excuse me, I mean, this broad correction consolidation phase. I do think there could be a little bit more upside for the greenback. And on interest rates, broadly speaking, I think that the Fed really is anchoring the short end of the curve. And so I think that we might get this stronger bouts of inflation, though. And that's really the highlight next week. CPI, both the core and the headline year over year look pretty steady. And that's going to give the Federal Reserve no real reason to be looking for a June rate cut.
Now, if we dive into U.S. stocks, though, especially the large cap stocks, which, look, led these markets. They do lead these markets because they consume so much capital. In tech, a lot of these large tech companies, they do business in the U.S., but a lot of their business is also international. Majority is international. And U.S. stocks, a lot of the companies are also very services oriented. And the U.S. has a big trade surplus in terms of trade services. Does that matter if we are just broadly seeing money leave the U.S.? But again, the fact that U.S. stocks, while they're listed in the U.S., they are global.
Yeah, I think that, that's what some people are doing, is looking at those U.S. equity ETFs that are listed in other countries, like in Europe, and trying to come up with some understanding about what's the flows in and out of the U.S. We've talked about this for a while, but I have been strongly encouraging people in my network to diversify away from the dollar. I had been thinking that the dollar was near a peak and that this was a good time to take advantage of what it seems to be a historically stretched valuation of the dollar and diversify into Japanese and European stocks. And from that might be the big picture, but of course, where the rubber hits the road is where you get in, what sectors you buy. But the idea is that the dollar is very rich. I look for it to weaken. I think that the premium that U.S. companies get is also going to diminish. But this isn't something that's simply like foreign investors. I think this applies to U.S. domestic investors who, because of the superior returns in the U.S., have come like too concentrated in the U.S. I think it's still, we haven't really seen a lot of flow data for April, besides what I mentioned, those ETFs. But we have seen perhaps one of the closest things to real time is, as we talked about before, the Federal Reserve acts as a custodian for foreign central banks. And in the last 2 weeks, so that brings us up through May 7th, 2 weeks through May 7th, foreign central banks reduced their treasury holdings by about $27 billion. In the big picture things, it's really just a rounding error. Foreign central banks have roughly $3.27 trillion in these securities, treasury securities and agencies at the Federal Reserve. So there has been some slight movement, but I think, again, that it's too early just to think that this is a capital strike against the U.S., especially given how fast the stock markets come back and that the U.S. dollar just made, say, 2 to 3 week highs against many of the major currencies yesterday, even though there wasn't really follow-through ahead of the weekend.
So because everything is happening so fast in terms of market and capital flows, even on the tariff front, yes, tariffs are announced and they're pulled back, then they're delayed, then some are put in. There's so much volatility going on out there. What's a reasonable time frame in your eyes for us to then put a bookmark in and say, okay, what is happening now? What are the trends that we are seeing that could be longer lasting rather than these month to month, even week to week moves?
Yeah, I think that the move's begun already, but I think that we've had a correction. I think this is the hard thing, right? Is that if you think about how the markets operate, is they don't fall in a straight line. I mean, we're lucky. I think that we had a period a few weeks ago where maybe sterling was up for almost 10 days in a row. These are unusual streaks. So well, I think that what we're having is this like more of a step function. We're walking downstairs. And so you'd expect to see the next high to be lower than the previous high and have lower lows, lower highs. So the definition of a downtrend. And so I think the U.S. stock market, if it had, I think it's peaked already. I think that the dollar's peak is behind us as well. And so I mean that's the kind of environment I think we're going to be in. I think I'm concerned that, too bad Chad's not on the call, but we've been talking about how so many people have been talking about recession, and I'm still concerned that we're still could be on the precipice, and that we should know in the next couple of months. So by the end of July, because think about what happens in July, we only get June economic data. And sometime then in the in the data we get for the month of June and in July, I think we're going to see a sharp slowdown in the economy, a weaker labor market, and that ultimately is what's going to get the Federal Reserve to cut rates again. Is not inflation is going to be in target. I'm still worried about the upside of inflation. But if the Federal Reserve sees rising unemployment, they will conclude that inflation is not going to go up much higher, that the weakness of the economy is going to cap inflation.
All right. Hey, Marc, great comments. Thank you so much for wrapping up this weekend show. There's just so much for us to take in on the economic and market side of things. And again, who knows how this is all going to play out, but there is this growing narrative that the U.S. is in for some tough times. And also the consumer is in for some tough times as we start to see some inventories dry up. Boy, oh boy, it's a lot for us to take in week after week, but it also gives us a lot to talk about. So everyone, please be sure to visit our website, podcast, YouTube channel, and also follow us on Twitter or X and on Substack. That's where you can keep up to date with all of our daily editorials and company updates from throughout the week, as well as extended interviews for the weekend show. Again, Marc Chandler, managing partner at Bannockburn Global Forex, also editor of the Marc to Market website. Be sure to click that link in the show notes. Marc, great chatting with you on this weekend show. And everyone, thanks for tuning in. I hope you all have a great rest of your weekend.
Thanks. Good luck to everybody.
The Corlin Economics Report is produced for A.B. Corlin and Associates. Opinions expressed on this program are intended solely for the entertainment of our listeners, do not constitute investment advice, and are not necessarily those of this network, radio station, or our sponsors. Find out more about this program and today's guests by visiting www.kereport.com. For Al Corlin, this is Colleen Robbins. Join us again next week for the Corlin Economics Report.